Most Canadian seniors signed a bank document years ago without reading page 3. What many don't realize is that this page may authorize your bank to share certain financial information with the CRA. And that's why some seniors are surprised when they receive CRA letters, account reviews, or requests for additional information. In this video, I'll show you exactly what's on that page, why it matters, and the costly TFSA and RRSP mistake that could put you on the CRA's radar. Let's get started. Why are banks doing this? The first question most people ask me is, why would my bank share my information with the government? Aren't banks supposed to keep my money private? And that's a fair question. So let's break this down in plain language. Your bank does not just hold your money. Under Canadian law, your bank is legally required to monitor your financial activity and report certain things to the government. This is not something new. It's been happening for decades, but the rules have gotten much more specific and much more aggressive in recent years, especially when it comes to seniors. There are two main players you need to know about here. The first is called FinTrack, the Financial Transactions and Reports Analysis Centre of Canada. That's a mouthful, so just remember it as the government agency that watches for unusual money movement. Banks are required by law to report to FinTrack anytime something looks out of the ordinary. We'll talk about what out of the ordinary means in just a minute. The second player is the CRA, the Canada Revenue Agency. You already know them, they collect taxes. But what many people don't realize is that your bank and the CRA have a formal information sharing relationship. There are agreements in place that allow the CRA to receive data about your accounts, your income, and yes, your withdrawals and deposits. Now here is where it starts to get personal for seniors. When you retire, your income changes. Money starts flowing differently. You start taking money out of your RRSP or RRIF. You might be selling assets. You might be receiving inheritance money. You might be moving money between accounts more than you did during your working years. All of that activity creates a pattern, and patterns are exactly what both FinTrack and the CRA are designed to notice. But before you call your bank and demand answers, you must understand this. The reporting is not inherently bad. It doesn't mean you are in trouble. Most of the time, it means absolutely nothing for the average person. The problem comes when the information being reported doesn't match what is on your tax return. That mismatch, that is what creates a CRA red flag, and that's exactly what we are going to get into right now. What is actually on page 3? Okay, let's talk about this form. Every major bank in Canada, RBC, TD, Scotiabank, BMO, CIBC, credit unions, they all use what are called Know Your Client forms, or KYC forms. You may have also heard them called Client Information Forms, Account Update Forms, or sometimes they're bundled into a package when you open a new account or update your banking relationship. These forms are typically 2 to 4 pages long, and the first 2 pages? Pretty standard. Your name, your address, your date of birth, your SIN number. But page 3, that's where it gets interesting. Page 3 of most standard Canadian bank KYC forms contains what is called the Tax Residency and Reporting Declaration section, and this is the section that triggers CRA and international reporting obligations. Here is what you will typically find in this section. First, you will see a question about your tax residency status. It asks whether you are a Canadian tax resident, a U.S. person, or a tax resident of another country. Most Canadian seniors will check the box that says they are a Canadian tax resident and move on. Simple enough. But wait, here's where things get interesting. If you were born in the United States, if you have ever held a U.S. green card, if you have bank accounts or property in another country, or if you have dual citizenship, that checkbox suddenly becomes very significant. Because if you are considered a U.S. person for tax purposes, your bank is legally required to report your account information directly to the IRS through an agreement called FATCA, the Foreign Account Tax Compliance Act. And through FATCA, that information makes its way to the CRA as well, because Canada and the U.S. have a reciprocal information exchange. Wait, it gets crazier. Even if you are a purely Canadian citizen with no U.S. ties whatsoever, page 3 still has teeth. There is usually a section that asks about the source of funds in your account. This is where you explain whether your money comes from employment income, pension income, investment income, inheritance, property sales, or other sources. Banks are required to keep this on file and update it regularly. Here is why this matters so much for seniors specifically. When you retire and your income sources shift, if the funds flowing into and out of your accounts don't match the source of funds you declared on this form, that is a discrepancy. and discrepancies are exactly what triggers a review. For example, you said on your form that your income is primarily from CPP and OAS, but then your bank notices you depositing $40,000 from the sale of some stocks, or an inheritance, or the proceeds of selling a rental property. That doesn't match what you declared, and your bank, by law, has to flag that. Now here's the part that really trips people up. Page 3 also typically includes what is called a third-party determination. This is a question that asks whether anyone else is directing the transactions in your account. Now, for most people, the answer is no, but for seniors who have a power of attorney in place, or who have a child helping them manage finances, or who have a financial advisor making moves on their behalf, this declaration becomes extremely important. If you said no third party is involved, but someone else is regularly moving money in and out of your account, that can look very suspicious to both the bank and the CRA. Not because you did anything wrong, but because the paperwork doesn't match the reality. And one more thing on page 3 that almost nobody reads, there is typically a consent clause at the bottom. This clause gives your bank permission to share your information with regulatory bodies, government agencies, and sometimes affiliated companies for compliance purposes. By signing the form, which you almost certainly did, you gave your consent to that sharing. You didn't do anything wrong, but you may not have known exactly what you were agreeing to. Now, before I give you the 3 specific things you can do to protect yourself, I want to circle back to something I mentioned earlier, that one big mistake seniors make with their TFSAs and RSPs. I'll get to that in just a moment. But first, you need to know what to actually do with this information. Step 1. Request and review your KYC form on file. The single most important thing you can do right now, today, is call your bank or walk into your branch and ask for a copy of the Know Your Client form they have on file for you. You are legally entitled to this information. Under Canada's PIPEDA privacy laws, that's the Personal Information Protection and Electronic Documents Act, you have the right to access the personal information your bank holds about you and to correct any inaccuracies. When you get the form, go straight to page 3. Check the following things. Number 1, is your tax residency status correct? Are you listed as a Canadian tax resident? If you have any U.S. connections whatsoever, make sure your bank is aware and that the form reflects your actual situation. Getting this wrong, in either direction, can cause serious problems. Number 2, does your declared source of funds match your actual income sources? If you've retired since you last filled out this form, your income profile has almost certainly changed. Make sure the form reflects your current reality. CPP, OAS, pension income, RRIF withdrawals, investment income, whatever applies to you. Number 3, is the third-party section accurate? If someone helps you manage your banking, make sure that is properly documented with the bank. This protects both of you. If anything is wrong or outdated, ask your bank advisor to update your KYC file right then and there. This is one of the easiest and most powerful things you can do to prevent a CRA mismatch before it becomes a problem. Step 2. Make sure your tax filings match your banking reality. The CRA doesn't usually come after people who have done something wrong. Most of the time, CRA contact is triggered by a mismatch between what your bank reports and what your tax return shows. So the second step is making sure those two things are aligned. Here's what I mean. If you received an inheritance this year, or if you sold your vacation property, or if you moved money out of a RRIF, those things are reflected in your bank transactions. The CRA has access to that picture through the reporting your bank does. If your tax return doesn't account for those things properly, that's where the red flag gets raised. Work with a tax professional, a CPA, or a qualified tax advisor, at least once a year to make sure your return captures everything accurately. This is especially important in years when your financial activity is higher than usual. Don't try to figure this out alone. The tax code for seniors in Canada is complex, and a qualified professional pays for themselves many times over by keeping you out of trouble. Step 3. Set up a cash transaction awareness plan. This is the one most people haven't heard of, so pay close attention. FINTRAC requires banks to report any cash transaction over $10,000. Automatically, no questions asked. That report goes to the government. But here is what a lot of people don't realize. Banks are also required to report what are called suspicious transactions, and there is no dollar minimum for those. A suspicious transaction isn't necessarily one where someone is doing something illegal. It's a transaction that is unusual relative to your normal pattern. A retired senior who normally deposits $2,000 a month from their pension and then suddenly deposits $25,000 in cash, That looks unusual. A senior who normally keeps a few $1,000s in their checking account and then suddenly starts making a series of $9,000 withdrawals. That also looks unusual. It's called structuring, and it's actually illegal even if the money is entirely yours and entirely legitimate, because the pattern implies an attempt to stay under the $10,000 reporting threshold. So what's the solution? Be predictable. If you are going to receive a large sum of money, whether it's the sale of a property, an inheritance, insurance proceeds, whatever it is, call your bank in advance and tell them what's coming. Ask them to make a note in your file. This simple step removes the element of surprise and prevents what would otherwise look like an anomalous transaction from being flagged as suspicious. And if you have a financial advisor, make sure they are aware of any large movements before they happen as well. Communication is the most underrated financial privacy tool available to Canadian seniors. The TFSA and RSP mistake. All right, I told you at the beginning of this video that there is one even bigger mistake seniors make with their TFSAs and RSPs that can practically invite CRA scrutiny, and I promised I'd come back to it. So here we are. This is something I see happen all the time, and it breaks my heart every time because it is so completely avoidable. Here is the mistake. Seniors over-contributing to their TFSA after the age of 71, or making withdrawals and recontributions in the same calendar year without understanding the rules, and in some cases, using their RRIF withdrawals in a way that creates a taxable income spike that lands them in a higher bracket, claws back their OAS, and simultaneously triggers a CRA review because the income picture looks dramatically different from prior years. Let's break that down because there are actually two problems hiding in there. The first problem is TFSA overcontribution. Your TFSA has a lifetime contribution room limit, and when you withdraw money from your TFSA, that room comes back to you, but not until January 1st of the following year. So if you withdraw $10,000 from your TFSA in June and put $10,000 back in September of the same year, the CRA considers that an overcontribution for that calendar year. The penalty is 1% per month on the excess amount. And yes, the CRA catches this, because your bank reports TFSA contributions and withdrawals automatically. The second problem is the RRIF income spike. Once you convert your RRSP to a RRIF at age 71, you are required to make minimum withdrawals every year, and those withdrawals are fully taxable as income. Here is where seniors get caught. They take out more than the minimum, sometimes to cover a big expense, or because they think it's smart to draw it down, and that extra income pushes them into a higher tax bracket. It may also trigger the OAS clawback, which happens when your net income exceeds a certain threshold. And because the CRA now sees a major income jump from prior years, it can prompt a review of your tax history going back several years. The fix for both of these? Planning. Strategic year-round planning with someone who understands retirement income for Canadian seniors. For your TFSA, track your contribution room carefully. The CRA's My Account portal shows your available room, but it is often a year behind. Keep your own records, and if you are going to withdraw and recontribute, wait until January of the next year to put the money back in. For your RRIF, work with your advisor to calculate the right withdrawal amount each year. Sometimes it makes more sense to take out a bit more in lower income years and less in higher income years to smooth out your tax bill and protect your OAS entitlement. This strategy is called income smoothing, and it can save you thousands of dollars over the course of your retirement. All right, let's bring it all together. Your bank is reporting your financial information to the CRA and to FinTrack. This is legal, it is required by law, and it has been happening for years. The form that authorizes much of this reporting is the KYC form you signed when you opened your account, specifically page 3, which covers your tax residency, source of funds, third-party involvement, and your consent to information sharing. The reporting itself is not the problem. The problem comes when what your bank reports doesn't match what your tax return shows. Mismatches create red flags. Red flags lead to reviews. Reviews can lead to audits. And audits, even when you've done nothing wrong, are stressful, time-consuming, and expensive. The 3 things I want you to walk away with today are these. 1C. Request a copy of your KYC form from your bank and review page 3. Make sure your tax residency status, source of funds declaration, and third-party information are accurate and up to date. 2. Work with a qualified tax professional to make sure your annual tax filing reflects your actual financial activity. Don't let mismatches happen. If your bank sees it, the CRA sees it. 3. If you are going to make any large or unusual financial moves, a big withdrawal, a large deposit, a property sale, an inheritance, call your bank in advance and let them know it's coming. Remove the element of surprise. And on the TFSA and RRIF front, know your contribution room, understand the withdrawal rules, and work with someone who can help you smooth your income from year to year so you're not accidentally triggering clawbacks or CRA attention. You worked hard your entire life to build what you have. You deserve to enjoy your retirement without the stress of unexpected government letters or surprise tax bills, and a little bit of awareness, the kind we just talked about, goes a very long way. If this video was helpful, please hit the like button. It helps more Canadian seniors find this channel. And if you know someone in your life, a friend, a sibling, a neighbor, who might benefit from this, please share it with them. This is exactly the kind of information that doesn't get passed along enough. Subscribe to Captain Matt, Retirement if you haven't already, because we talk about real money issues for real Canadian seniors every single week. No fluff, no jargon, just plain talk about protecting what you've built. I'll see you in the next one. Take care of yourselves.